Hello, this is Leroy Meadows, and welcome to this session. In this session, we're going to talk about inventory costing methods and capacity analysis. In this chapter, we're actually going to break up between inventory costing and capacity analysis. So you should expect to see a second video regarding capacity analysis in our denominator level when we're talking about budgeting and we're talking about predicting fixed manufacturing cost per unit. So inventory costing. So what are we looking to do in this chapter between this session and the next section? Well, we're looking at to identify what distinguishes variable costing from absorption costing. And these are terms that you should have remembered from managerial accounting. Compute income under absorption costing and variable costing, and explain the differences in income. Understand how absorption costing can provide undesirable incentives for managers to build up inventory. Then we want to differentiate throughput costing from variable costing and absorption costing. And then in the next session, we're going to talk about describing the various capacity concepts that firms can use in absorption costing, examining key factors that managers use to choose a capacity level, and then also figure out and understand other issues that have an important role in planning in capacity. So, with that being said, give me just a moment here. And let's talk about inventory costing. Inventory costing, we're looking at two different common methods of inventory costing in manufacturing companies. These are variable costing and absorption costing. The choice, whether we choose variable costing or absorption costing, is going to determine the manufacturing costs that are treated as inventoriable or what you may have been called product costs. So the choice we use is going to determine what our manufacturing costs are and what we count as inventory on the balance sheet. And then the next session, we'll talk about given a firm's level of spending on fixed manufacturing costs, what type of capacity level should we use in making our budgets, in making and calculating our fixed manufacturing cost per unit, and things like that. Okay, so let's take a look at variable costing and absorption costing and throughput costing. Now, variable costing is a method of inventory costing in which all variable manufacturing costs, direct and indirect, are included as inventoriable costs. So, in other words, under variable costing, we're looking at just variable manufacturing costs, such as direct materials, direct labor, and variable manufacturing overhead. And we ignore fixed manufacturing costs in this situation because even though it's a manufacturing cost, it's not variable. And there's going to be a reason why here. And we'll look at that in just a moment. Absorption costing, on the other hand, is a method of inventory costing that all manufacturing costs are included as inventoriable costs. So all manufacturing costs, direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead will all end up on the balance sheet as inventoriable costs and then expensed off as cost of goods sold as we sell each additional unit. So, in other words, we're absorbing all manufacturing costs. And absorption costing is really just what we've done up to this point. Our product costs have been direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. And when we compute cost of goods sold, we take the full product cost, what we just mentioned, direct materials, direct labor, variable and fixed manufacturing costs per unit, times the number of units sold, gives us our cost of goods sold. And throughput costing is a method of inventory costing in which only direct materials are included as inventoriable costs. All other costs are expensed. So let's take a look here and let me go to and illustrate this. The best way of doing this is to illustrate it. And let's say I make widgets. And each widget, as we see right over here, is selling for $13. I'm going to have direct materials cost of, and let's say direct materials cost of $2. And let me just put that here. And direct labor is going to be $3. And let's make our selling price for our widget $16. Okay, so what am I going to do here? Let's take a look at the cost per unit using absorption costing and variable costing. So under absorption costing, I'm going to include in my cost per unit direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead on a per unit basis. So what is my direct cost per direct material per unit? $2. So I'll put my $2 here. And my cost of direct labor, $3. Variable manufacturing overhead, let's say that's, and let's say it's $1.50. And then under absorption costing, we include fixed manufacturing overhead because that is an actual product cost. So how am I going to compute my fixed manufacturing cost per unit? Well, I'm simply going to take my total fixed manufacturing costs, 6,000, and let's divide it by the number of units we sold. And in this case, we produced and sold 1,500 units. We marked it right here. So when I take 6,000 and divide it by 1,500, I should get $4 per unit. So my total product cost per unit under absorption costing is going to be the total of direct materials, direct labor, variable manufacturing overhead, fixed manufacturing overhead, and that gives me a cost per unit of $10.50. Now let's look under variable costing. Variable costing says I'm only going to take the variable manufacturing costs and use that as to compute my cost per unit. So direct materials, that's a variable cost, so we're going to include that. What about direct labor? Is that variable or fixed? Well, it's variable, so I'm going to go ahead and include that. Variable manufacturing overhead of $1.50. And fixed manufacturing overhead, we do not include in variable costing. And the reason we do not include fixed manufacturing overhead in variable costing is because that concept's tied to capacity, not necessarily manufacturing on a direct level, because a lot of it is tied to how many assets do we have? What are my fixed costs? What are my uh, warehouse rent? It's all tied to size and capacity. How much can we produce? So under variable costing, it is assumed that fixed manufacturing overhead is a period cost and not a manufacturing cost. And there's a reason for that, and that's because fixed manufacturing costs tend to be tied to capacity, or how much can we produce. So under variable costing, I'm not going to include any fixed manufacturing overhead. So my variable cost per unit will be $6.50 per unit. And that's a big difference. And we're going to look at it a little bit later why we might want to look at variable costs, and then also why we might want to look at absorption cost per unit. So now let me give you another measure that you're going to see again. It's not included in the book, and it's not really clearly communicated in the examples at the end of the chapter. So let me just go ahead here and do this. So cost of goods sold. Under absorption costing, I'm going to take my full cost per unit, $10.50. And that's $10.50 times the number of units sold. And here we see 1,500. So my cost of goods sold under absorption costing will be $15,750. Now, what about under variable costing? Under variable costing, my cost of goods sold is going to be my variable manufacturing cost per unit. And we computed that here, 650. So 650 times the number of units sold, 1,500. And under variable costing, my cost of goods sold is going to be $9,750. A big difference. Where is that difference? That difference is in the cost of, or is in the fixed manufacturing overhead costs. And here's how we can do that. See the difference in cost of goods sold between absorption and variable costing? What is that difference here? Well, if I compute that difference, pull this up here, 15,750 minus 9,750. My difference in cost of goods sold, which we'll also see a little bit later on, my difference in cost of goods sold between the two methods is exactly going to be the fixed manufacturing cost. Why? Because under variable costing, my fixed manufacturing costs are expensed in their entirety. Under absorption costing, I include those in the product cost. Those product costs will sit on the balance sheet until they're sold, and then they'll be expensed off as cost of goods sold. So let's take a look here, and let's take a look at the absorption costing income statement. Under absorption costing income statement, I'm going to take and it's just a traditional gross margin or gross profit format income statement. So let's say I sold 1,500 units. Based on that, how much in revenues did I get? And did I receive? Well, I remember I sold these up here for $16 each times 1,500 units sold. So my revenue is going to be 24,000. Now, less my cost of goods sold. So I'm going to take that, and what was that for under absorption costing? 15,750. And that gives me what? What does that give me for gross profit? And let me go over here. So gross profit again, revenues minus cost of goods sold. So when I do that, what is my gross profit? My gross profit, $8,250. Minus my variable and selling expenses. And what were my variable and selling expenses? My variable and selling expenses, selling and administrative expenses were what? $1.75 times 1,500. So what is $1.75? Oops. It was what? $2,625. And I'm going to get rid of this row here. And let's say my fixed selling administrative expenses were only $1,000. We're going to change that dollar amount there. Minus my fixed selling and administrative expenses, so minus 1,000. And, oops. And so what's my operating income? My operating income is going to be what? My gross profit minus my variable and fixed selling and administrative expenses. So that's going to be what? 8,250 minus 2,625 minus $1,000. My operating income is $4,625. Now under variable costing, let's take a look and see how operating income changes. Okay, so let's take a look at revenue. And our revenue we already calculated up here is 24,000. And what was our variable cost of goods? Under variable costing was 97.50. And let me go ahead and format there. Minus our variable selling administrative costs. And how much is that? $1.75 times 1,500. And that gives me what? 1,500 times $1.75 is $2,625. And yes, we did calculate that up there as well. So our revenues minus our total variable costs gives us our contribution margin, just like what we did before. So let's figure that out. And our contribution margin is 11,625 minus my fixed manufacturing costs, which were what? 6,000, and fixed selling administrative costs we figured out here was 1,000. So what is my operating income? It's going to be my contribution margin minus my fixed manufacturing costs minus my selling administrative costs that are fixed. And I'm going to get $4,625 as well here. Now, this illustration was just to illustrate how to do variable and absorption costing as far as on a per unit basis, and then how to do the income statement. Now, as you notice, what do you notice? My operating income is the same, assuming that we produce and sold the same amount. So there's no change in inventory level. So when there's no change in inventory level or production is equal to sales, then we have our operating income is going to be the same. However, as we'll notice, our operating income will be different depending on the changes in inventory level. So let's go ahead and go back here and go to the PowerPoint here. Now we will notice here that operating income will differ between absorption costing and variable costing if inventory levels change because of the difference in accounting for fixed manufacturing costs. Let's go back here to my example here. What if we had produced 1,600 units? So if I had produced 1,600 units and we only sold 15, so produced 1,600 units, I would have what? My ending inventory would be what? My ending inventory would be what? 1,000 units. Or 100 units. Sorry. And what is my inventory level going to be at, if I have ending inventory under variable costing, inventory balance, under absorption costing versus variable costing. My inventory level under my ending inventory balance under absorption costing is going to be what? My $10.50 per unit times 100 units. So what is that? Let's see, $1,050. Now, under variable costing, what is going to be my ending inventory balance? Well, it's going to be my cost per unit of $650. We computed that up here, times 100 units, and that's $650. So why do we have that change? Well, we have that difference because under variable costing, fixed manufacturing costs are going to be expensed in their entirety no matter what. Under absorption costing, because we're including fixed manufacturing costs in the cost per unit, we're only going to expense off the fixed manufacturing overhead associated with the unit sold. Remember, costing, the cost per unit is going to end up on the balance sheet, and then we only expense off what's cost of goods sold, or the number of units we sold as cost of goods sold. So my ending inventory is going to be different. Why? Because fixed manufacturing costs are going to be expensed off as a period cost in its entirety. Whereas fixed manufacturing costs under absorption costing only when units are sold. So if we have a difference in the level of production versus what's being sold, then we're going to have a different ending inventory balance. And the difference in ending inventory balance is what? $400? That would be the difference in our operating income, because we're going to have the same $6,000 of manufacturing costs. It's just that under absorption costing and variable costing, my operating income is going to differ by the fixed manufacturing costs that are inventoried between the two methods. So my difference in ending inventory is what? $400. Oops. And this will be the same difference in operating income if we do if we compare between absorption costing and variable costing. So let's take a look here and redo this under variable and absorption costing. Now this is not going to be tied in, so we're going to change these numbers, because as we work through this illustration, I was just using these numbers here to illustrate a principle. Now we're actually going to compute everything. So we're going to get a new fixed manufacturing cost, overhead cost per unit, because now we're producing more units. And why is that? Because I'm taking the same $6,000 of manufacturing costs, spreading it out over more units. So let's say we produce 1,600 units. So what's my fixed cost per unit? $6,000. Spread out now, instead of 1,500, we're going to spread it out over 1,600, because let's say we're making more units and we didn't sell quite as many. So my fixed manufacturing cost per unit is $3.75. So now my cost per unit is $10.25. And again, of course, that makes sense, because if I'm producing more units and I'm taking a certain amount of fixed costs and spreading them out over more units, remember it has that inverse relationship between total fixed costs and cost per unit. So what is my cost of goods sold now? If I sell 1,500 units, well, I'm going to take B6 times there, times which is the cost per unit, times 1,500 units sold. And I'm going to have, in fact, let me just tie that in here, $15,375. And now let's change that, because now my costs per unit are a little bit lower since I'm producing more. My revenue still 24,000, because I still sold it for $16 per unit per widget, times the number of units sold, which is what, 1,500. So in fact, let me go ahead here, and that way we can do a sensitivity analysis too if we wanted to at some point in the future. And this is what? Now my gross profit is what? $8,625. Minus my variable selling and administrative expenses, which is what? Which are what? Is $1.75 per unit times 1,500 units. I have 2,625 minus my fixed selling and administrative expenses, which is what, right down here. And that gives me what? That gives me $5,000 of operating income. Now let's take a look and let's see under variable costing, what is my operating income? And again, my variable costing income statement is based only on the variable cost per units sold for my variable cost of goods sold. So what are my variable cost of goods sold? We computed that up here. And why did this not change? Because we never included fixed manufacturing overhead. So I've got my operating income of $4,625 here. So what is the difference in operating income? The difference in operating income is what? 5,000, and let's see, is 5,000 minus $4,625. So my difference in operating income is what? $375. Now let's take a look at my ending inventory balance. And what is my ending inventory? Well, I have 100 units in ending inventory times my cost per unit up here, $10.25. And that gives me ending inventory of $1,025. What are my variable costing ending inventory balance? Well, my 100 units times a variable cost per unit of $650 gives me $650. And what is the difference between the two ending levels of inventory? $375. So in other words, I did this second part of the illustration here to illustrate that the difference in ending inventory under the two methods is also going to be the difference in operating income. Why? Because fixed manufacturing costs were expensed only when units are sold under absorption costing, and in variable costing, fixed manufacturing costs are expensed as a period cost in its entirety. So variable costing, all fixed manufacturing costs are getting expensed regardless of whether units are sold or not. Under absorption costing, we're only expensing fixed manufacturing costs as a product cost only when those units are sold, because they end up on the balance sheet first, and we only expense off the units that are sold from the balance sheet. So there is an illustration, and in your book has that illustration of the Stassen company. And then so this is an illustration of the difference, and the difference not only of computing variable costs and absorption costs, but it also illustrates the difference between variable costing and absorption costing, its impact on the income statement, and also its impact on ending inventory balance. So now let's go back here. And so again, the amount of difference represents the amount of fixed manufacturing cost capitalized as inventory under absorption costing, and the amount expensed off as a period cost under variable costing. And here's the illustration in your book here, where if when production is different than sales, then our operating income is going to be different between the two types of costing methods. And how can we compute the difference in operating income between different years? Again, we have the difference in ending inventory will also give us the difference in operating income. And when there's a change in inventory levels, then there's going to be a change in the operating income difference. So, and as we see here, manufacturing cost expensed, variable, and cost of goods sold, which is why we get the difference here. So now let's take a look at the variable costing and absorption costing for Stassen Company. Now remember, we talked about fixed manufacturing costs as being related to capacity. So with capacity, when we remember our variance analysis, we were talking about in the previous chapter, in chapter 8, we were looking at variance analysis for fixed manufacturing overhead. We talked about a production volume variance. And we simply stated that the production volume variance was the budgeted fixed manufacturing cost minus the fixed manufacturing overhead that's been allocated using the budgeted cost per output unit allowed, times the number of actual units produced. In other words, I can calculate like this, but a little bit easier way to do this is take my fixed manufacturing cost per unit, whatever that is, and multiply that by the difference between our budgeted level of output and our actual level of output. In the Stassen company, we budgeted in the second year for 8,000 units, but we only produced 5. So what is my production volume variance related to that capacity? Because I had capacity to make 8,000 units, and that's what I budgeted on, but I only made 5,000 units. So I want to take the difference between what I budgeted to make, my 8,000, because that's what I had planned on allocating on a per unit basis. In that denominator, based on my allocation base, the number of units, I budgeted 8,000 units, and I wanted to spread my fixed costs over 8,000 units. However, I only produced 5,000 units. So the difference in operating income between the two methods is going to be $405,000, and that is going to be unfavorable. Well, my operating income is going to be a little bit different. It's not going to be that, but my production volume variance rather is going to be $405,000 unfavorable. Why is it $405,000 unfavorable? Because I had capacity to make 8,000 units, but I only made 5,000 units. So that production volume variance of 405,000 is going to be tied to is unfavorable because we wasted or we had unused capacity. I had capacity to make 8,000, but I only made 5. So that $3,000 or 3,000 units difference represents unused capacity. I had the capacity to make that 3,000, but I did not use it. So therefore, $405,000 of fixed costs, or the difference between the two, is going to be unfavorable. That production volume variance is unfavorable because it's tied to capacity not used. So although we had a difference in operating income in 2017 between variable and manufacturing and absorption costing, we had variable operating income of $1,230,000. Operating income under absorption costing was $1,500,000. So we had a difference there. And that was tied to fixed manufacturing cost and variable costing being expensed off immediately. Whereas under absorption costing, those units were not expensed off until we actually sold. So if the cost of fixed manufacturing inventory is sitting on the balance sheet, it can't be expensed off. So my total expenses that I'm reducing revenues by is going to be less. Then it stands to reason I'm going to have more operating income. And then we see the illustration here from 2018 as well. So let's take a look here. And here is an important exhibit in your book. And in your book, you can find this on page 338. And and it gives us an overview of variable and absorption costing. And again, under variable costing, fixed manufacturing costs are related to capacity, and they really are. So we want to use variable costing for certain decision-making processes that we're involved in. When there's absorption costing, fixed manufacturing costs should be expensed as cost of goods sold because it is tied to production. So, and let's take a look here. And let's look here at the middle here. And here is a key thing. When production is equal to sales, operating income is going to be equal under either method, variable costing or absorption costing. But let's say we produce more than we sold. Operating income will be higher under absorption costing and lower under variable costing. And we saw that, didn't we? Let's go back to the illustration here. Production income, when we produced more than we sold, absorption operating income was higher than variable costing operating income. So we saw that illustration right here. Now, when production is less than sales, so let's say we produce less than we sold, that would mean that if we produce less than we sold, what would happen? Well, we would obviously have to have beginning inventory. Because if we had no beginning inventory, there's no way we can produce less than we sold. So we produce less than we sell, then variable costing will have the higher operating income, and absorption costing will have the lower operating income. So this right here is going to be key. You're going to need to know this because this is going to help you think things through, help you solve certain problems, of course, and be able to make some identification. So you want to make sure that you are aware of when there's a difference between or how production relates to sales and what happens to operating income under each method. Now, absorption costing is required inventory method for external financing reporting, such as GAAP. So for GAAP measures, when we're releasing financial statement, such as a balance sheet, income statement, so forth, we need to be using absorption costing because that is what GAAP requires. IFRS also requires that, and in most countries, absorption costing is required. Absorption costing is also preferred because it's cost effective and less confusing. We know anything related to manufacturing is part of cost of goods sold, part of the cost per unit made, and then how we can value our ending inventory. It can also help prevent managers from taking actions that make their performance measures look good, but it hurt the income that's reported to shareholders. And then another reason why is measures the cost of all manufacturing resources necessary to produce inventory. So we want to include all the costs of the resources being used to produce inventory. So we want to include all of those costs together. Now, with this, we have to take note that absorption costing allows a manager to increase margins and operating income by producing more ending inventory. Why? Because remember, the fixed manufacturing cost per unit decreases the more production increases. And that's because, remember, the same amount of fixed manufacturing costs or fixed costs in total is going to be reduced on an inverse basis to a cost per unit. So when we're producing more units, we can flood our ending inventory, and a lot more of that fixed manufacturing cost will be tied up in ending inventory. And if it's not expensed off, there's going to be less expenses, so my operating income is going to be higher under absorption costing if I produce more than I sold. Now, producing for inventory is justified when we're having rapid growth and we want to produce and have additional units for, let's say, safety stock, which we'll talk about here in a future chapter. Safety stock, because, or maybe we'll have, because we want to have, why would we have safety stock? Well, we might have an unexpected increase in sales. We want to make sure we cover those sales. Remember, during the pandemic, we had runs on toilet paper, paper towels, food, a lot of things, Clorox wipes. So if we're rapidly going to see a growth in demand, having ending inventory and producing just for inventory is great. Or when we're having additional shortages in the next year. Now, one thing it can do, it can have a negative effect. For example, let's say my bonus or a manager's bonus is tied to operating income. But I also want to keep people busy. So I want to produce, make my numbers look good because I'm more productive. I have a higher productivity rating. So when it looks like I'm more productive, but if all that stuff is going to sit in ending inventory, then yes, my operating income is going to be higher if I'm judged by absorption costing operating income. Because a lot of those costs are sitting in the balance sheet, they're not expensed off, so my operating income is going to be higher. But what happens if we're producing for a lot of inventory and then we don't have the anticipated demand and we don't have production shortages? Then we have an issue where we have an excessive amount of inventory. And with an excessive amount of inventory, we have higher costs of insurance, cost to, higher obsolescence costs, higher spoilage and shrinkage costs. We have a lot of extra costs, insurance costs. We have a lot storage costs. We have a lot of extra costs tied in to the storage of that additional units. So if we're going to sell it, we could go ahead and incur those costs because we know we're going to sell the units. But if we're not, that stuff is just going to sit there and sit there and sit there. And there's a lot of reasons why we don't want to have a lot of inventory if we're not going to sell those units anytime soon. And we'll look at that in a different chapter. So what can we do to reduce the undesirable effects of absorption costing for performance evaluation so that a manager or a shift supervisor can't just produce just to have a higher bonus if it's tied to absorption operating income? Well, we can carefully budget and inventory planning. We can put restrictions on how much can we produce, put systems in place so that we can't overproduce by an excessive amount. We can adjust that absorption operating income so that it can be reduced or have an internal charge for carrying inventory. In other words, make and implement a penalty for having excessive inventory, which would then reduce the incentive to have that excessive buildup. We can change and lengthen the period used to evaluate performance. So instead of just looking at last period or the last two periods, maybe we can lengthen that out to look how things have changed over the last year or maybe even 2 years, multiple periods, not just this past or most recent period. And then also non-financial levels. We can use ratio analysis to do was the change of ending to beginning inventory ratio of units and compare that to the units produced and sold. So we can do some internal things to penalize the buildup of inventory levels when they're not warranted. We don't want to penalize people and penalize and incorporate internal carrying charges when the buildup is warranted. However, if a manager is just trying to game the system to make their own bonus better, then we have a situation where we do not have goal congruence where the manager's goals and the company's goals are not being aligned in the same direction. You have the company wants to go one way and the manager is going a different way. And when that happens, the manager is looking out for him or herself and not for the best of the company as a whole. Now, there's an extreme version of variable costing called throughput costing. This is an extreme method. Throughput costing is sometimes called super variable costing, in which only direct material costs are included in inventory. Everything else is treated as period expense. So what happens with throughput margin equals revenues minus direct materials. That is what we call throughput margin. And that is our cost of goods sold, is just the number of units sold times the cost per direct material. We don't spend a lot of time in the book, but we do want to introduce the concept. And that's because, and the reason or the thinking behind throughput costing is that direct material is the only pure inventory cost. All other costs are the costs related to capacity to convert direct materials to a finished good. So throughput margin is revenue minus all direct material cost of goods sold. Direct material cost of goods sold under throughput margin is simply their direct materials cost per unit times the number of units sold. And then we have an illustration here for the Stats & Company when they're producing their telescopes. And we have the illustration here. And let's just look at 2017. Revenues, $1,000 per telescope times 6,000 telescopes sold. And we look at under throughput margin, only the direct materials cost of goods sold. We do that by taking our beginning inventory, multiply that by, and then we take, get our direct materials cost of goods sold here, for a throughput margin. Other manufacturing costs are expensed off in their entirety. Just like variable costing expenses off fixed manufacturing costs in their entirety because it's related to capacity, whereas absorption costing doesn't. Under throughput costing, all manufacturing costs that are not direct materials related are expensed off in the same period, as well as marketing costs and other fixed costs to get operating income. So we have a difference here in throughput costing where the variable cost, where the cost of goods sold is only the cost of direct materials, $110 per unit, times the number of units sold, 6,000, which we get 660,000 here. And that we have a new measure under throughput costing called throughput margin, which is revenue minus a direct materials cost of goods sold. Everything else is expensed off to get us our operating income. And as you can imagine, operating income is going to be different for absorption costing, variable costing, and throughput costing, depending on the number of units produced if they do not equal the number of units sold. So, and we actually have our costing systems compared between actual costing and normal costing, and then standard costing. And so this would be a very good thing to look at, make some comparisons. Maybe that'll help you understand it a little bit better. Absorption costing includes all these: variable direct manufacturing costs, variable manufacturing overhead costs, fixed direct manufacturing costs, and variable manufacturing overhead costs. Now, we rarely talk about fixed direct manufacturing costs, but there are rare occasions, or there are some occasions, I should say, where direct costs can be fixed. It just depends on the cost object itself, whether that is variable, whether that particular cost is variable or fixed. It all depends on what the cost object is. We can see fixed direct manufacturing costs. I know I mentioned it in an earlier chapter. We're assuming that all manufacturing costs are variable, or all direct costs are variable. But that's not a blanket 100% true statement. It is true in general, but that's only because of the situations we've been exposed to. Depending on the cost object, or what is it we're trying to get a measurement of cost for, certain costs can be direct and fixed as well. So this is Leroy Meadows. This concludes this session. Next session, we will pick up where we're leaving off, and we're going to deal with capacity and dealing with the denominator level capacity concepts, fixed cost capacity analysis, and we're going to pick up from there. So I want to thank you for joining me this session. Have a good day.